Whoever has the most gold that they can bring out to back their national currency is going to be the big winner here, because it's going to be gold backstopping, because nobody's going to buy treasury debt. Nobody's going to buy China's treasury debt. Nobody's going to want the US dollar or even the renminbi in China. Why would you? If you have a collapsing economy, you're going to go buy a bunch of their currency and their debt? No, you're not. It's paper value. They're going to go to gold. So if China and Russia have more gold reserves, they'll do better. I think that's what's going to happen. Ultimately, when this all comes down to it, it's going to be who has the most gold.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for August 14th through August 21st, 2023, while supplies last. This week we feature Silver Buffalo rounds at just $2.50 over spot. The Silver Buffalo is made by various private mints across the U.S., with a design based on James Earl Fraser's iconic Buffalo nickel. They are highly recognizable and one of the most trusted types of bullion rounds available. These 3/9 fine rounds come 22 a tube and 500 to a box. And at just $2.50 over spot, they offer unparalleled liquidity at a price lower than many high-volume bars. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Robert Kientz from GoldSilverPros. Rob, thank you so much for joining us today.
Hey Elijah, thank you for having me on.
Well, it's great to have you back. Our viewers always appreciate hearing from you. I did want to discuss what you've recently been reporting on. It seems like the banks are actually getting out of their short positions on precious metals right now, and the banks are usually right in the direction that the metals are going to be heading. So can you expand on the significance of this?
Yeah, essentially what happened, and this data is always a week old because it's on the Commitment of Traders report that the regulator, the CFTC, puts out. So the latest data I have is through August 8th, so we're about 10 days behind. But on that report, in both gold and silver, they had dumped basically a lot of their short positions. As I look at it, through August 8th, they had dumped 12,500 silver short positions, and they were slightly net long on silver. And then they also dumped about 15,700 short gold positions. Now, they still have a much bigger short on gold. As of August 8th, they're still sitting at 230,000 short contracts. So gold is going to take a lot longer to unwind, but it appears as though they're anxious to unwind some of that gold and silver. Now, when I first reported on this, I suspected that they were probably positioned to go long in the fall, and I still think they are, especially in silver. There's enough dumping of those shorts that they're slightly above net even or slightly net long, if you will, that I don't think that they're about to then go add a bunch of shorts again. But we've had some price weakness lately, and without looking at the new Commitment of Traders report, which probably won't be out until this afternoon, I suspect that they're probably adding some shorts. And so what they did essentially is they dropped some short positions to short cover, whether it be their own positions or some positions that the managed money hedge funds had. So it's them basically taking profit on the market and helping their financial buddies take a little bit of profit on the market. But the moves were so big, I do think it's not just that. It is positioning to go long in the fall. I'll warn people, though, however, we could still have some downward drift in prices. Gold finally this week drifted below its 200-day moving average on the technical charts, which is a slightly bearish sign. Gold right now is trading, around 1,900. Do I expect gold to fall to 1,700? No, because of the economic fundamentals. But, the banks can kind of play this game for a while, so they may go and do some more short covering again. And, you could see the fade in the price. But I do think that was a signal, so many contracts at once in both gold and silver, that really they wanted to dump, take their profit, and begin to slowly move long into it. And I think that they're doing that because they're seeing what we're seeing with regards to the banks and wages and all of that type of stuff that we're going to talk about today, meaning the economic fundamentals are deteriorating so badly now, and not only in the U.S., but also in China. China's basically right now, their debt markets and a lot of their state-owned entities, their quasi-governmental entities are in pretty serious trouble. And I think the banks see that. They read the writing on the wall. I think Fitch even came out and said when they warned about downgrading the banks' credit ratings, the big commercial banks, Fitch basically called for a recession in quarter 4. So I think the writing's on the wall that we're headed straight to a recession. And so I think what I see on the COMEX and on the derivatives and futures markets is the banks are starting to move net long. Now, I do think that they're going to kind of step into it, but eventually they're going to be positioned long so that when, that big rush into gold and silver comes, which I don't think is going to be too awful far from now, they're going to be well positioned for that.
Now, when it comes to, I guess, going into the end of the year, it sounds like we might see some further downside, but pretty much it seems like the banks are positioning to take advantage of an upward move.
Yeah, they're positioning to take advantage of an upward move. Of course, this always happens over time, but definitely the size of that short covering, I suspect they're not. If you look at it, they've had such huge short positions in gold and silver for so long. That size of position to me means that they dumped a bunch of that long-term position. That doesn't mean they can't add a few more shorts, but they're not going to add 15,000 more shorts in a week. What they're doing is they're gradually removing big chunks of shorts where they can without losing a bunch of money. And they're basically handing those losses to the rest of the market. So I think this is the beginning of their big move. I think that's a positioning for the big guys. If you look at the retail trade like SLV and GLD and those ETF type trade that you see a lot of the retail sentiment now is a little bit weaker. That's typical for late summer. August, usually is not a great month from a retail perspective. Although I think given the issues in the economy, that fade hasn't been nearly as strong in retail as I would have thought that typically happens during the summer. So I think there's a lot of signs pointing to people being a lot more bullish. And I think last time we talked about how the millennials are buying so much gold in the ETF. So overall, I think we're pretty healthy in this market. You're going to get a little bit of late summer fade every summer. But I think the positioning is clear that the big guys want to go long in the fall. And again, the downgrade of the U.S. Treasuries by Fitch and the warning that they're about to downgrade the big commercial banks in the U.S. is basically pointing to the fact that we have a higher risk of credit default and maybe even an eventual sovereign default of the U.S. government coming. And so I think that's why they're positioning to go long, because if any of that happens, then we're going to have pretty massive moves up in the gold and silver price.
Now, when it comes to what is happening in the general economy, I know you recently reported on wages, and as you mentioned, there are negative things happening outside the U.S. as well, in China specifically. But can you expand on kind of a broad view of what's happening right now?
Yeah, so on wages, we have an issue. I was just doing, a study as I do about things over time, and I was studying wages back to the 70s, and the average median wage of all workers over 16 years of age, according to the BLS, and I got this data off of the Fed's website. They sourced it from the Bureau of Labor Statistics. From I think it was 1979 to now, that'd be 44 years of data. The average median wage, discounted for inflation, had only gone up $30 a person. So less than $1 a year. In fact, 75 cents a year of wage gain. And that's if you believe the government inflation numbers, which I don't. Because the problem with the government inflation numbers, and I wrote about this in my book, Drop Shadow, Chapter 2 is 50 pages of data about government statistics. And CPI specifically has had hedonic adjustments, geometric weighting, flat out removal of certain key parts of the economy like rent and certain energy prices, substitution effects. The CPI number is really no good, because if you look at whether or not you believe that number, it still doesn't work, because CPI now is measured differently than it was in the 1990s, measured differently than it was in the 1980s. So it's not an apples to apples comparison. So you can't look at any CPI chart and say, yeah, okay, I see how that's working, because they changed the math. And so as I was looking at wages and I started going back to the 1980 calculation methodology, wages have actually gone down in real terms in over 40 years. And they've gone down a lot. Okay, so people, the average person 16 or over, whether they work part-time or full-time or whatever they're doing, has actually lost purchasing power over the last 44 years. And the only thing that's gone up over that period of time, even considering inflation, has been gold. It's not been the stock market, it's been gold. And gold is the only thing that's been able to capture that loss of purchasing power. And I like to call this the labor tax or the wealth tax. Because when you print so much money, especially since 1971, we got removed off the gold standard and we had this pure, free floating fiat currency. We just print as much as they want, nothing to regulate it. And we've seen all these deficits. Over 80% of all purchasing power in the US dollar has been lost since the 1970s, since 1971. And that has decimated wages. That's why people cannot keep up. They simply can't. The power of their dollar has gone down, and the statistics are really clear on that.
Now, as for the general economy, how bad do you see it getting? Because obviously, if we have these issues in China as well, it seems like not just a domestic issue, it's a global issue. And obviously, the financial system is very interconnected. So something going bad in China can also impact the U.S.
Yeah, so I was also doing a study on the banks for our program this week. So I downloaded the banking data for the commercial banks from the FDIC. And it's a big data table. I think there are between 4,600 and 4,700 banks on my spreadsheet here. In fact, I'll give you a count. I downloaded all the banks, and the number comes to 4,672. Okay, of those 4,672 banks that register their data with the FDIC, 4% of them are showing net loss for 2023. To the tune of, as I look at my chart, $2.6 billion. Okay, not catastrophic given the size of the U.S. economy. I think last year we had $25 trillion GDP. $2.6 billion is not going to crash us. But listen to this. The rest of the 96%, over 4,400 banks, made income this year so far of $82.5 billion. Well, sounds like a pretty good number. But when you look on all their assets, over $23 trillion, they're returning just over 3% on assets. Well, that's not much better than a grocery store. And the banks aren't making a lot based on what they have. And what that essentially means is their return on their capital is not great. The banks are not super healthy. And if you look further at the assets in jeopardy, those 4% of banks, that I think 260 some banks, that have a negative net income for this year or a net loss, their assets in jeopardy are now $703 billion. So we're sitting there with an impending collapse of $703 billion. That's bigger than the banks that we saw collapse earlier in the spring, that in addition to Silvergate and SVP and First Republic, we have another 4% of banks, some 260 some, that if they don't start making money, they're at collapse risk also, and $703 billion. And if you look at the fact that, if you look at my past research on liquidity ratios, all the big commercial banks are sitting at, I think it was 78.8% of loan to value according to S&P Global Intelligence, which means they don't have a lot of room for losses. If they take on losses, they could be in trouble. So, if we go into recession, the total amount that could be in trouble is over $23 trillion assets in the banking system, according to the FDIC, which is, one of the regulators. And that's 23 trillion. That's almost our entire GDP for last year is now at risk if this banking contagion continues to spread. And further, I went further into FDIC data, and I noted that this year we've had 3 bank failures. Well, what happened during the last recession in 2008? Well, the first year we had 25 bank failures. In 2009, well, we actually had more. We had 140. Okay. In 2010, it kept going. We had 157 bank failures. Okay. And then in 2011, we still had 92. And in 2012, we had 51. So when you go in recession, it's not just a one-time deal. And the government can't. The FDIC program can't make everybody whole. The government can sit there and ease and print all they want. They still can't stop the bank failure. Once the bank failures start, it's going to run. It's like the domino effect. You knock one domino over and the whole thing just keeps going. And so if we get into another recession, we've got $23 trillion with a T, trillion dollars at risk in the banking system. And they're not making enough money right now that they could withstand it. In fact, we reported this a couple of weeks ago on our channel. They're borrowing to fund their regular everyday operations. Because even though they made $82 billion in net profit, that's such a small amount considering all the loans that they have to service. It's a little baby amount that they're making. It's like if you earned $50,000 a year, but you only saved $100 during the whole year because you're paying all these bills and you still got $30,000 in credit card debt. You're in big trouble as an individual. That's where the banks are. They're in trouble. they're in deep trouble. And the next recession, they're in even deeper trouble. And if we have another $1 trillion come out of the big banks in terms of consumer deposits, they're even in more. Between April of last year and June of this year, $1 trillion in consumer deposits came out of the commercial banking system. If that happens again, a lot of these banks are going to default. It's not going to be 260 banks that have losses. It could be 1,000 banks that have losses. And if you look at the total number of banks that we had in the 5-year period, there were, I think, 446 banks, I think, that went bankrupt during the Great Recession. But they didn't have $23 trillion in assets. It could be 1,000 banks easily this time, maybe even 2, and you're looking at a much bigger potential loss in the economy. So everything's gotten bigger. And, you know, the profitability is not there for the banks. The liquidity is not there for the banks. Consumers are pulling out their deposits. Banks aren't making enough profit. And they're borrowing from the wholesale market. And we haven't even officially got to the recession yet. So I'm a little bit worried about the banking system right now. It's not particularly healthy at the moment. And to expand on China, since, you know, we were talking about before the recording, word out of China is that their biggest, Evergrande just filed for bankruptcy. Their next biggest property development company, Golden Harvest, is now trading pennies on the dollar. And their analysts are saying that the Chinese economy could collapse. This could be where the Chinese economy goes into serious trouble because a lot of their state-owned entities, not only in real estate, but across the board, are in serious trouble. If you look at lending for business, it's less than half of what it was a couple of years ago. And the amount of defaults and default risk has gone way up in China. And their profitability is going down. So their market is experiencing the exact same thing as the U.S. market. One of the reasons why we're their biggest consumer. And guess what? All of our purchases to them, which makes up our current account balance, how much we buy, how much they buy, and what's the difference? We usually run huge deficits. We're buying more stuff from China. They're buying from us. Well, that gap has closed a lot, which means we're buying a lot less from them. And if you look at foreign purchases right now for China, meaning the U.S. and Europe, they've plummeted. So China is not getting the money into their economy they're used to, and they're starting to default across the Chinese economy. This is not just a U.S. thing. This is the 2 biggest economies in the world thing. And that's starting to worry me quite a bit. When you have the 2 biggest economies in the world, both having massive credit and potential default problems at the same time, that's a really big issue.
Now, when it comes to here in the U.S. and the banking issue, what do you think about like the big 6 banks, you know, JP Morgan, Bank of America, all those banks? Do you see them to be in trouble as well in this crisis?
They could. When I looked at the FDIC data, though, JP Morgan's got enough income from their commercial operations that they can withstand a lot. They're not the best position, but the bank in second place, and let me go down and look at this data. I've actually got the table here. Listen to this. JP Morgan, if I look at my numbers, that's assets and net income. JP Morgan has $3.2 trillion in assets, and they made $11 billion in net income. Not too bad. Now, again, their return on net assets is not fantastic. The next one is First Citizens Bank and Trust. Now, riddle me this. They have $214 billion in assets, and they made $9.5 billion. They might be the best positioned bank in the entire U.S. They're making 4.5% on assets and net income. That's ridiculous. They're actually better positioned than JP Morgan. Bank of America, a little bit smaller asset, $2.5 trillion in assets, but they made $8.2 billion. So some of the bigger banks, Wells Fargo, $1.6 trillion in assets, $6 billion. Again, their return on assets is not great. It's not. And so you're not going to have robust dividends. If they get into trouble with their liquidity ratio, the big ones could be in trouble. They could. You could see some issues with JP Morgan, Bank of America, Wells Fargo, Citibank, 1.7 trillion, earnings of 4.5. They're making decent earnings, but as a percentage of, their assets and their capital, it's not big. You could see some big defaults in the big ones. I think the U.S. government doesn't want JP Morgan, Bank of America, or Wells Fargo to break. But the only thing they could do is either guarantee assets, basically means amounts to guaranteeing debt for those companies backed by U.S. Treasuries, or printing money. Well, who in the world wants to buy a Treasury that's backing a defunct U.S. bank? Because U.S. Treasuries are themselves are sitting over 5%, a lot of them. The world has already said you've got a lot of default risk there, and they know a recession's coming. So who in the world's going to buy, if the U.S. tries to backstop a lot of these big banks, who's going to buy that? No one. And if they go and print a bunch of money and try to cover all these trillions of dollars in assets and keep these banks from going under, that's considering the money they already printed after the pandemic and the deficits we're running now, and you add the banking system on top, it would bankrupt the U.S. government. So this time it could be a little bit different. Back in 2008, it was mostly Lehman, Bear, some of those banks, and the contagion could have been very nasty, but you had the big guys like JP Morgan step up and help with that situation. Now, what do you do if JP Morgan's in trouble? There are a few banks at the top will probably be okay. But if you look at the amount of actual bank branch closures, we're running more bank branch closures in 2023, the fastest we have in U.S. history. So what they're trying to do is they realize consumers are pulling out deposits. Why service a bunch of bank branches if consumers just pulled $1 trillion in deposits out in the last year? They're closing, they're cutting costs. They're preparing for what's going to happen. They know defaults are coming. So they're trying to get rid of as much cost as they can. Well, what does that do? It puts a whole bunch of people out of work, and they're sitting there, I don't have any money left. Well, it's a double-edged sword for the banks. Yeah, you can fire people, but they've got loans to the banks in terms of consumer credit, in terms of auto loans and home loans. So the more losses that occur in job loss actually puts the banks in a worse position at a time when they've lost a lot of consumer deposits. So any way you look at, I don't know how the banks get out of this. I don't know how the U.S. government gets out. If the U.S. government tries to backstop a bunch of the auto companies, a bunch of corporations and banks this time, like they did in 2008, it's not going to work. And they don't have the credit quality of the U.S. Treasuries that the rest of the world's going to go, oh yeah, we're going to buy it. And besides, the other big economies in the world have their own issues. Look at Japan. Japan is spiraling right now. China's in trouble. Who's going to go buy all that stuff? What's the backstop now? I'll tell you the only backstop. It's not the U.S. dollar. It's gold. Whoever has the most gold is going to win this little battle. Whoever has the most gold that they can bring out to back their national currency is going to be the big winner here, because it's going to be gold backstopping, because nobody's going to buy treasury debt. Nobody's going to buy China's treasury debt. Nobody's going to want the U.S. dollar or even the renminbi in China. Why would you? If you have a collapsing economy, you're going to go buy a bunch of their currency and their debt? No, you're not. It's paper value. They're going to go to gold. So if China and Russia have more gold reserves, they'll do better. I think that's what's going to happen. Ultimately, when this all comes down to it, it's going to be who has the most gold.
And I guess we'll see next week with the announcement possibly from BRICS about a gold-backed currency. We'll see how that plays into everything there. Any last thoughts before we let you go, Rob? I know it'll be good to have you on pretty shortly, probably, and see what the BRICS says. But it sounds like your view is that gold is really the only solution here to this crisis.
Pretty much is, because that the BRICS countries led by China and Russia are doing their gold-backed currency. They've been talking about it for a long time. The big announcement is supposed to come, I think, the 22nd. But honestly, it's a foregone conclusion. We've known for years that they were planning this because leaks came out, analysts said it. I mean, we didn't know, but we suspected. And why wouldn't you? What else are you going to back it with? Not only that, Zimbabwe's got one going. We're seeing states here in the United States propose gold and silver as tender. We're seeing states have bills proposed to do their own gold-backed digital currencies on a state-by-state basis. Like, when's the last time we had state currencies in our history? Especially gold-backed. I mean, you got to go way back in time to see anything even remotely like that in our history. So not only is the rest of the world lining up behind gold, but a lot of states are lining up behind gold. I don't know what the federal government's doing. They say they have about 8,000 tons, but do they really? Haven't had an audit in 60-some years. If you're an individual out there and you're looking at this, man, you cannot expect the government's going to be able to save you. We're going to have massive bank failures. And the only way to save yourself, I think, is to go into gold. And if you can't afford gold, go to its little brother, silver, which is, the poor man's gold, because that's the only way you're going to save yourself. I think that's the only way you're going to capture value. And when all of this collapses, it's a big, if you look at Exter's pyramid, all the derivative stuff is sitting up here, and then you have a little bit of gold and silver here on the little bottom. All that value, that notional value of all the derivatives, all the currencies, all the stock market, all the crap paper in the system is going to go right down to gold and silver, and you're going to see the value of gold and silver go this way. And that's the way you stay solvent. This is how you win the game. You go to the assets that have the best value, the asset of last resort, which is gold and silver. So when that house of card collapses in on itself, you're left standing with the highest value asset. That makes you the king. Okay, and you can be a king in your own life by holding precious metals in your portfolio. And certainly countries that have been buying a lot of gold and silver will end up as the kings on top of everything when all of this is said and done.
Fantastic. Well, Robert Kientz, people can go to GoldSilverPros.com and the Gold Silver Pros YouTube channel, which we'll link in the description of this video. Any last thoughts before I let you go? And can you tell us a bit about your work?
Yeah, so we do, for every Friday, we do a weekly market wrap-up where we dive into the details of gold and silver on our channel. Of course, you can find us on YouTube, Twitter, and some other outlets as well. But I'd also say just stay tuned to this channel. This is one of the best channels going. You guys talk more than economics. You talk a lot of different things, and you provide a lot of information to people. So just stay right here on Liberty of Finance, watch those videos. If you're doing that, you're ahead of probably 98 to 99% of Americans, to be honest with you, and you can feel pretty good about that. We're all going to go through some amount of pain, but the better prepared you are, the better off you're going to be. And yes, economics is a big part of it, but you've got health, you got your spiritual, you've got food, shelter, water, those types of things. So stay tuned to Liberty and Finance because they've got a lot of great guests on there who are going to help you with all of those things.
Well, thank you so much, Robert. And I will say about your YouTube channel too, one of the things that I'm always impressed is how fast you are to get the news out. Like you're the first one to get it out there. So thank you so much for your work there. I'll put the link in the description. Once again, thank you so much for your time and God bless.
Thank you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.